Good morning. This is Rob Janezic here with the Janezic Realty Group at RE/MAX Executive. As many of you know, I'm an educator as well, and that's what we're going to focus on a little bit this morning here, a little bit of education. Often people who are looking for a home or an investment property say they want to buy foreclosures, and we go to MLS and we look for foreclosures. What I want to do is bring that to light a little bit. So what we're going to talk about today specifically is the process of purchasing a home and obtaining a mortgage, which in itself could be a misnomer, but that's not the point of this. North Carolina has deeds of trust, work much like a mortgage. So we'll just call it a mortgage, even though it's not technically correct, and we can explore that in another video. So we're going to talk about the mortgage. A buyer looking at a house, needing to buy and not having enough money. What do? They go to a bank and they talk to that bank about getting some money so that they could make this purchase. Well, the bank just doesn't want to give them money because they want to make sure that they can get that money back. And it might not be from this person, so therefore what they want is they want this property to be used as collateral to secure that debt. So they're not just going to give you money, you're going to have to give them a promise, a promissory note. Spelling's not my forte, real estate is. A promissory note. That is, I promise to pay you back the sums of money that you gave me. But that's not enough. A promise is not simply enough, so they make us give them another document called a mortgage. And a mortgage is a security instrument. It says in the document itself, all the language, it says, if I fail to pay my promissory note, you, bank, have the right to sell this property after following the appropriate procedures, to sell that at public auction for cash. And that is the foreclosure sale. And we'll get into that. So right now we're just setting it up. The buyer wants to purchase the house from the seller. They needed the money. This is how they secured the money. Now what we need is the seller to give us a deed. A deed is the transferring of the property rights. Now, in this picture here, we also have what we call the Register of Deeds or the courthouse. The Register of Deeds is where we have public records. Before this buyer did even go to buy the house from the seller, they wanted to make sure that that seller, in fact, was the appropriate owner. So what they wanted to see was a deed from when they acquired the property from whoever sold it to them. And that deed should be in the public record so that we can verify that it is, in fact, that person's home. And now when the transfer happens, we're going to record the new deed in the public record so that we can see that the new deed, dated later, supersedes the previous one, and now that this is the new owner of the property. But the bank also wants this mortgage document recorded because that's their interest in the property, and they want anyone who's interested in that property to be able to go to the Register of Deeds and see their financial interest. And we're going to, again, call that the mortgage document, although in North Carolina it is a deed of trust. So that is the setup. What we're going to talk about next in the subsequent video is buyer sue, failing to make the payments of that loan, and what transpires. Thank you.